Hi. Let's learn about government bonds, what it is, types, pros and cons. A government bond is a debt security issued by a government to support government spending and obligations. Government bonds can pay periodic interest payments called coupon payments. Government bonds issued by national governments are often considered low-risk investments since the issuing government backs them. Government bonds issued by a federal government may also be known as sovereign debt. Government bonds are issued by governments to raise money to finance projects or day-to-day operations. The U.S. Treasury Department sells the issued bonds during auctions at regular intervals throughout the year. Only certain registered participants, often large banks, can buy U.S. government bonds directly at auction. Some Treasury bonds trade in the secondary market, and individual investors can buy and sell previously issued bonds through this marketplace. Fixed-rate government bonds can have interest rate risk, and only select bonds keep up with inflation. Local governments may also issue bonds to fund projects such as infrastructure, libraries, or parks. These are known as municipal bonds, or munis, and often carry certain tax advantages and exemptions for investors. U.S. Treasuries are nearly as close to risk-free as an investment can get, while government bonds from other countries may carry a greater degree of risk. Due to their low risk, U.S. Treasuries tend to offer lower rates of return relative to other investments. However, government-backed bonds, particularly those in emerging markets, can carry risks, such as country risk, political risk, and central bank risk. Government bonds assist in funding deficits in the federal budget and are used to raise capital for various projects such as infrastructure spending. Government bonds are also used by the Federal Reserve Bank to control the nation's money supply. Government bonds provide a steady stream of interest income but usually offer lower returns due to their lower level of risk. The market for U.S. government bonds is very liquid, and there are even ETFs and mutual funds that focus their investment on Treasury bonds. However, fixed-rate bonds may fall behind during periods of increasing inflation or rising market interest rates. Foreign bonds are exposed to sovereign or governmental risk, changes in currency rates, and have a higher risk of default. There are various types of bonds offered by the U.S. Treasury, including savings bonds, Treasury notes, Treasury bonds, and Treasury inflation-protected securities. The national debt in the U.S. largely refers to the notional value of outstanding government bonds. When governments need to raise funds for operations or to invest in projects, they can sell bonds to investors. In the U.S. case, bonds are sold through the Treasury and represent debt owned by bondholders. This makes bondholders of Treasuries essentially creditors to the federal government. Bonds issued by the federal government are considered to be essentially riskless, which is why their interest rates are usually lower than other types of bonds. Corporate and other bonds must carry higher yields to compensate investors for the additional credit risk that are inherent to them. The U.S. government has a variety of different Treasury securities available for purchase, including Treasury bills, Treasury notes, Treasury bonds, Treasury inflation-protected securities, floating-rate notes, FRNs, Series I savings bonds, and Series II savings bonds. Foreign governments around the world issue debt in the form of bonds. Some of these commonly include. Here are 11 key takeaways. 1. A government bond represents debt that is issued by a government and sold to investors to support government spending. 2. Because of their relatively low risk, government bonds typically pay low interest rates. 3. Face or par value, the amount of debt you are loaning the government and the amount you will get back when the bond matures. 4. Coupon, the regular interest payments credited to bondholders. 5. Yield, the interest rate on the bond after accounting for its market price. 6. Market price, the price of the bond in the secondary market, which may differ from the face value. 7. Treasuries, U.S. federal government bonds. 8. T-bill, short-term treasuries, maturing in 1 year or less, a 9. T-note, medium-term treasuries, maturing in 2 to 10 years, 10. T-bond, long-term treasuries maturing in 10 to 30 years or longer, 11. Tips, treasuries that are indexed to inflation. Hope this would help. Thanks for watching.